Afternoon, everybody. My name is Roxana Jubilus. I'm a homeownership counselor and director at the Housing Development Fund. And I'm so happy to be here. Thank you for the invitation. Thank you to the Ferguson Library for inviting me and to LaShawn for inviting me here today. Today, I'm going to talk about the overview process of buying a home, but also about the programs that are available in Connecticut for down payment and closing costs. So I'm going to start by telling you basically who we are. HDF is a housing development fund. We're a HUD-approved agency, and we've been around since 1990. We provide counseling, education, down payment, closing cost assistance, loan products to help first-time home buyers buy their home. And I want to explain to you about the home buying process. You need to educate yourself. Maybe I'm going to remove this so I can move around a little bit. So you need to educate yourself on the home buying process before you buy a home. Because in my experience, I've been a counselor for 15 years. And sometimes I see clients that what they do is they start looking for homes first, and they don't even know if they can afford it. So it's very important that you educate yourself on the home buying process. If you educate yourself, you will know what to ask, what to look for. Also, you should be working with a housing counseling agency. I mean, you don't have to, it's not a requirement. The bank is not gonna require that you do that unless the program that they are giving you, the loan product that they are giving you, requires that you have a counselor, that you get counseling services. You need to learn about the different mortgage options, because if you don't know what the different mortgage options are, you don't know if maybe you can get a better interest rate, maybe if there is a better mortgage for you. And then you should know if you are mortgage ready, because oftentimes clients, they don't know if they are mortgage ready. And what I mean by mortgage readiness is what the bank is going to look for. And the programs for down payment and closing costs also require that you meet certain criteria. You need to have a stable employment. What most banks want to see, if you want to get a conventional loan, they want to see that you have at least 2 years of a stable employment within the same occupation. It doesn't have to be with the same employer, but within the same occupation. Credit history. Lenders will order a credit report that includes information from the 3 credit bureaus, from Equifax, Experian, and TransUnion. Now, depending on the loan product that you are getting, they may also require that you have a minimum credit score. Right now, for instance, most lenders for a CHAFA loan, a conventional loan, they want to see 660 or above. Now, if you get a different type of loan, like an FHA, they require a minimum of 520 or above, but that depends on the lender. So you need to ask the lender, okay? Now, the bank also, not only they look at the score, but also they are going to look to see if you have some credit activity. Because what happens is that if you don't have any credit activity, they don't know whether or not you make your payments on time. And what they are gonna ask you is that you get 3 letters. And it could be from the utility, it could be from cable, it could be from your cell phone, and to make sure that you had made the payments on time for the past 12 months. Oftentimes, in addition to that, they also want to see the rent, to see if you had paid the rent on time for the past 12 months. Now, oftentimes when I pull credit reports, I see that clients, they don't have sometimes any credit history. And that happens a lot. And then clients, now they don't have a score, there is no credit history, and sometimes they don't even have any letters to show that they have been able to pay on time. And that happens also oftentimes with the students who just graduated. They don't have anything under their name, everything is under their parents' name. And now there will be an issue for the bank to give you a loan if you don't have any credit history. And if you don't have any non-traditional credit, the non-traditional credit are the letters that I was telling you before, the letters from a utility, from a cable, from your cell phone, insurance. So it's very important to know what is on your credit. There is a website, www.annualcreditreport.com, and it's for free. You can pull your credit report, it doesn't affect your score, and then you will be able to see what is on your credit report. It won't give you the score. If you want the score, you have to pay for it. But if you don't want to see the score, you just want to see your history, that is a good way to start. And it gives you the choices if you want to see it from Experian, from TransUnion, from Equifax. And I will recommend you do that. If that's what you want to buy a house is your goal, start by looking what is on your credit report. Sometimes I see clients that they didn't know they have a collection account. They didn't know that there was a past due account. And then clients, they just find out. And God forbid, there is identity theft. You know, God forbid. But if you are not looking at your credit report, you wouldn't know. So it's very important that you look at your credit report. At housing development funds, when clients come to us, they pay for a credit report, and we pull from the 3 credit bureaus just to make sure that they are not going to be issues by the time they go to the bank. And if we see there are issues, we guide the clients and we tell them what they have to do to be ready. Yes, we do help. The only thing that we cannot do is we cannot contact the credit bureaus on your behalf. But we look at the credit report and we see what areas you need to improve. And then we tell you, you need to contact or you need to do this, but then you have to do it. There are credit counseling agencies that they can do things on your behalf, but we're not a credit counseling agency. So we cannot do things on your credit on your behalf, but we tell you what you need to do and then you do it. Yes. So the bank also look at ratios. What is that? Ratios determine the affordability. When banks are looking to see how much they can lend you, they need to see what is your income and what is your debt. And that determines how much they can lend you, because the front ratio or the housing ratio is the payment that you are going to pay every month, including the mortgage, property taxes, homeowners insurance, and common charges if you buy a condo or a co-op. Then the bank takes a look at your income and says your payment represents, let's say, 35% of your income. And they have criteria. They may say, we don't want more than 30%, more than 35%, or maybe more than 40% of your payment to be part of your income. So they will take a look at your front end ratio or housing ratio, because the lenders, they want to see a maximum amount that you can afford. The letter that they give you when you go to the bank to get pre-qualified or pre-approved, they will tell you the maximum. That doesn't mean that you have to use the maximum. You can request for less money, but the bank is going to determine how much they can lend you based on your affordability, and that is determined by your income and your debt. Now, the debt to income ratio or the back end ratio is what you are going to pay every month, the mortgage, property taxes, insurance, and common charges if you're buying a condo or a co-op, plus your debt. And they may have a requirement that that payment shouldn't be more, let's say, than 41% of your gross monthly income, or it might not be more than 42%. If you are applying for our, let's say, our down payment and closing cost, our ratios are, for the front end ratio should not be more than 35% of your gross monthly income. For the back end ratio should not be more than 41% of your gross monthly income. Now we're talking about gross monthly income if you are an employee. If you are self-employed, then we look And the banks will look at your net income after all of the deductions when you are self-employed. Okay, because I mentioned that because oftentimes I have clients that on their tax returns, they let's say they make $100, I mean 100,000, but after the deductions, it shows the net to be, let's say, 10,000. The bank is gonna take a look based on the 10,000, not on the 100,000, and that is for a self-employed. I mentioned that because oftentimes clients, they think, no, but I make, let's say, 100,000, but that's not the case. The bank is gonna look at the net when you are self-employed. If you are an employee and get a pay stub, then it's based on the gross income, okay? Now the assets. Also the bank is going to take a look to see if you have the money for the expenses of buying a home. And what are those expenses? So the expenses are gonna be your down payment, because certain banks, they may require, depending on the loan product that you're getting, that you put down, let's say 3%. Other loan products require 3.5%. There are other loan products, like for instance, ours require 1% that you put down, but you need to have the money in your savings account or your checking. It cannot be cash that you have at home, because oftentimes I have clients who tell me, oh, I do have more than 1%, but it's under the mattress. And if it's not in the bank account, it doesn't count. You need to have it in your bank account. So you need to have a minimum. You have the down payment requirement. Again, like I said, it varies from the lender. It could be 1% that you need. It could be 3%. It could be 3.5%. I've seen some programs that even require 5% that you put, and even 10% or 20%. So you need to be aware, how much do you need to have in down payment? If you are using our program, like I said before, you're required to have 1%, and you need to put 1% of the purchase price. You also need to have for reserves. Why? Because when you go to the closing to buy your home, the bank doesn't want to see that you don't have anything in your bank account. God forbid something happens. You need to have some reserves. And again, that depends on the loan product that you are getting. You may require to have 2 mortgage payments in reserves. Usually that's the case for a single family or a condo or co-op. If you're buying a multifamily, now you need 4 mortgage payments in reserves. That's what I see with most banks, and that's what we want to see as well. But I know that there are other banks that they may even want more if you're buying a multifamily. I've seen lenders that may require even up to 6 months in reserves, yes. But you need to be aware that you need to have the money for the expenses of buying a home. What I see many times with my clients is that they come to us for the down payment and closing costs, but they are under the impression that they don't have to put any money. And I tell them, no, you do need to put for the 1%. You also need to have for the reserves. The reserves is not an expense, but it's money that you need to have to show that you have it. Now, many lenders allow that could be a gift. The reserves could be a gift, but the down payment must be out of your own pocket. Now, there are also closing costs that you will have to pay when you are buying a home. And the closing cost, just to give you an idea, is about 4% of the loan amount. It could be more or less depending on the bank, but let's say that you are taking a mortgage of 200,000. 4%, just to give you an idea, will be around 8,000. But it could be lower. I mean, depends on the bank. It could be lower. It could be 6,000. And that's why it's important to shop around, because not every bank will have the same closing cost, and you need to ask. Now, if you don't have for the closing costs, then you should be looking at agencies that provide closing costs like ours. We provide closing costs for clients, but you need to be able to you need to be eligible. Now, there are other expenses that the bank is not going to require, but is highly recommended. The inspection. Why? The bank doesn't require that you do an inspection, but it's highly recommended. I hear many stories about things happening when people don't do an inspection. And sometimes when people are looking at houses, sometimes they waive the right to do an inspection. I wouldn't recommend that you do that. You need to know the condition of the property. Now, the inspection is not part of the closing cost. That's money that you pay directly to the inspector. If you don't know of any inspectors, there is a website, ashi.org, ashi.org. You type in the city where you're buying and the state and give you a whole list of certified and licensed inspectors. Now the fees varies too from one inspector to the other, but you can ask. Now, all of the inspectors that you see on that website are certified and licensed. So you don't have to be asking if they are licensed or certified, because in order to be on that website, they need to be licensed and certified and taking continuing education. Now, just to give you an idea, on a condo, they might charge you around $400 to $500. If it's a single family house, you're looking at a price of about $600 to $700. If it's a multifamily, then you're looking at a little bit more, but it varies from inspector to inspector. It's not that there is a flat rate for everyone. So you can shop around. Now, in addition to the inspections, they do a general inspection. You should also do a radon test. A radon test for a single family house, not on a condo, because radon is a gas that you don't see it, you don't smell it, but it comes through the soil and it goes up, and it's very harmful to your lungs. And I heard inspectors saying that it is the second lead cause of lung cancer, radon. It's not requirement that you do the radon test, but it's highly recommended. And you usually pay around $100 to $200 for the radon test. And it's highly recommended that you do that. Now, those costs, it add up. You need to have for your down payment, you need to have for the inspection, you need to have for the closing costs, you need to have for reserves. You also need to have for the appraisal, because the bank orders an appraisal. And the appraisal is different than the inspection. The appraisal, the bank orders the appraisal. You do not order the appraisal, the bank does it. Now, they do that to compare how much other properties have sold in the area, and they arrive at the market value, how much that property is worth, and if it's worth what you are paying for. And that's what they want to make sure, that is, the appraisal comes at least at the purchase price. If it comes below, then they may deny the loan, or they may ask you that you put the difference, because they don't want to lend you money for something that is not worth what you're paying for. Now, if it appraises higher, good for you. You're buying something at a lower price and it's worth more. So that's good. But you need to pay for the appraisal. And oftentimes the bank asks you that you pay that up front when they are going to send the appraiser. Now that costs around, just to give you an idea, between $400 to $550. That's what I've seen. So you need to be prepared to pay for them, okay? Also, there is another expense, and that is the homeowner's insurance. Almost every bank that I know for a conventional mortgage, they usually ask that you pay for 1 year of homeowner's insurance prior to the closing. God forbid there is a fire on your home. And I'll tell you a little story. You remember, all of you, I guess, remember Katrina, right? When that Katrina happened, there were people who signed, they bought a house in a day before, or the same day they were buying, nobody knew. They knew there was a hurricane, but nobody knew the magnitude. Now, for that, you needed flood insurance, but God forbid if you don't have insurance, I mean, if God forbid there is a fire. Homeowners insurance is for fire, somebody falls, then you are in a lawsuit, you need to have coverage. Now, flood insurance is separate. Okay, homeowners insurance doesn't cover flood. You need to have a separate flood insurance. Now, the bank is gonna tell you whether or not the property is in a flood zone. They have a map. So not every property requires flood insurance. The bank is gonna let you know. They'll tell you if they look at the FEMA map and they'll tell you if it's in a flood zone. And then if it is, they are gonna require. All right. And you need to be prepared to pay that. And usually they want that you pay for the whole year prior to the closing. So you need to be prepared to pay for those expenses. That's not part of the closing cost, the homeowner's insurance, the inspection, the appraisal, and flood insurance if it's needed. Now, if you're buying a condo, usually the condo insurance covers flood insurance. You still will need homeowner's insurance for your own unit, but usually flood insurance is covered under their insurance policy, but you still need to verify, okay? So once you are mortgage ready, so that you know that you have the money in place, that you have 2 years of a stable employment, that everything looks good on your credit, there are not gonna be any issues, that you meet the credit criteria for the lender, then you go to the bank to get pre-approved or pre-qualify. Some banks, they do a pre-qualification. Some banks, they prefer to do a pre-approval. The difference between those two is that with pre-approval is confirmed data. The pre-qualification is information you provide to the lender, to your loan officer. But a pre-approval, it goes further. It goes to underwriter and then is confirmed data. They are actually verifying your income. They are actually verifying your credit. They are verifying your assets. So with a pre-approval is more formal. A pre-qualification is more informal. Now, you go to the bank. Keep in mind when you go to the bank to get pre-qualified or pre-approved, they are going to ask you for documents. You need to be prepared. It's a very good idea that if you're looking to buy a house, that you start organizing your paperwork. They are going to be asking for tax returns, most likely for the past 3 years, with the W-2s. They are going to be asking for pay stubs. They are going to be asking for 1099s if you're self-employed, and if you get 1099s. They also will be asking you, they will be pulling a credit report, and they might ask you upfront that you pay for the credit report. And you need to be prepared to have that documentation ready, because oftentimes clients, they start looking for the tax returns, they cannot find them. If you cannot find your tax returns, you can go to the IRS website and you can request for the transcripts. Now, if you go to the irs.gov, you create an account and you'll be able to pull your transcripts. You just, it's right away. You just, enter your information, you create an account, and then you can right there print or upload your transcripts. Okay, but it's important that you have that documentation, so that way they can do your pre-approval. Now, once the bank gives you a pre-approval, then you contact a real estate agent. You can still buy a home if, let's say, you are in a neighborhood where the owner is selling the property. They might put their sign for sale. Then that's fine. Then in that case, there is no realtors involved. The seller is selling directly. The owner is selling directly. But that is the small percentage of the transactions happen that way. Oftentimes it's most likely will be with a real estate agent. So you contact a real estate agent, you tell the real estate agent what is it that you're looking for. And I will suggest that you have a conversation with your family to see what are the needs. Because oftentimes I have clients that oftentimes when I do the counseling session, for instance, the spouse says, I need a garage. That's my need. I need a garage. And then the other spouse says, oh, no, 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 no. For me, a must is to have 2 bathrooms. And then it's important that you write down what are your needs. So when you're talking to your real estate agent, you know exactly what you're looking for. Of course, I mean, you need to be aware that depending on how much you can afford, then your options might be a little more limited depending on how much you can afford. If you cannot afford, a high amount, perhaps you need to compromise with certain features that you are looking for. Um, just to tell you a story, when my husband and I, we were buying a home, for him, it was important that he had a garage, indoor garage, and a basement. Those were the only 2 things that he was asking, that he wanted it. For me, I really wanted like a walk-in closet, but that's what we wanted. And then when we went to get pre-approved, I mean, we bought our house before I was a homeownership counselor. So, we got pre-approved for an amount that it didn't allow us to have all of those features. So, we had to end up buying a small house without a garage. It had a driveway, but it had a basement, and it had like not a walk-in closet, but it had a big closet. So we compromise. Sometimes, depending on what is it that you can buy, sometimes you may not be able to get everything that you are looking for, all the features that you're looking for. But it's good that you know maybe what can you compromise. But it's important that you have that dialogue with your real estate agent. Um, and also be clear, do you want to buy a multifamily? Do you want to buy a single family house? Do you want to buy a condo or a co-op? Um, and I'm telling you this because oftentimes I have clients who they get pre-approved, and when I ask them, they come to us, I ask them, what are you looking to buy? What type of property? They said to me, well, my bank told me that if I buy a multifamily, I can have a tenant who's paying the mortgage. But I said, do you like to be a landlord? Oh, no, I don't want to be a landlord. So sometimes you have to ask yourself that question. I mean, are you prepared to be a landlord? Now, there are classes, landlord training, that if you're planning to be a landlord, or even if you don't know, it's good that you do take that class, the landlord training class, because you are going to learn what are your right, what are the tenants' right, and what are your responsibilities as a landlord, because you have to know what are your responsibilities as a landlord, and what are the tenants' rights too. All right. So you start researching the area where you're looking to buy. You can go and see open houses. You prepare the financial documentation. And once you find a home that you like, then your realtor will put the offer on your behalf. Your realtor is representing you, and then the realtor will put an offer. Now, sometimes there is a little bit of negotiation, especially in this market where the houses are not lasting that long. And, and, and it could go back and forth, maybe you put an offer and the seller come back saying, well, I had many offers, come back with your best offer. And, but your realtor will help you in that transaction and will give you an idea how much to put an offer for. And it can give you, your real estate can give you comparisons, how much other properties have sold in the area. So that way you have an idea how much to offer. Once you have an accepted offer, that's when you are going to contact the inspector. So it's very important that when you present your offer, your real estate agent will know that there should be contingencies, contingent to having an inspection done. Don't waive your right to do an inspection. I've seen it, clients, they do it, especially in this market, because they said, okay, I won't do an inspection, so the seller is a little more eager to accept your offer. But as a counselor, I wouldn't recommend that you do that. You do your inspection. So it should be when your real estate agent puts the offer, it should be contingent to having an inspection done. So if after the inspection you decide that you don't want to buy the property because there are too many issues with the property, you're going to get your deposit back. If there is no contingency, or if you're waiving your right, you may lose your deposit. Okay, so you have to understand that there should be contingent to having an inspection done. Also, that an attorney reviews the contract. You need to have an attorney reviewing the contract, and also should be subject to a mortgage contingency. So if, God forbid, you do not get the loan approved, you get your deposit back because there is a contingency. But keep in mind that oftentimes when there are contingencies, the seller is gonna, usually the contract will have days, how many days you have to do an inspection, until when you have to get the approval for the mortgage, all right? But your attorney will go over that with you. And then that's why you need to contact a real estate attorney to represent you, not only to review the contract, but also to review the closing documents. After you review and sign all the legal documents, then you go to the closing, and your attorney will be there with you at the day of the closing, because the day of the closing, you are gonna sign a lot of documents, and your attorney will be there telling you, this is what you're signing. This other document, this is what you're signing. And usually you're signing the note, the mortgage note, the deed, and you need to have an attorney. Now, what down payment and closing cost is available in Connecticut? You should go to the HUD website, which is hud.gov, and you can search by state, and then you see all the towns that have HUD approved agency. And now the agencies may have down payment or closing cost assistance. You should also ask your lender. Oftentimes your lender works with counseling agencies, and they may know what programs are available in the community, or they may, or for instance, there are banks that they, from time to time, they have grants. I know, for instance, in the past, like Citibank, they used to have, or they still have 5,000 gift towards a closing cost. Liberty Bank in the past, they had, sometimes they have, sometimes, you know, they only have it for a period of time, but if you don't ask, maybe the loan officer might not consider that option, you know, so you need to ask, do they have any grants, anything for closing costs? And maybe they do. Now, also, like we're Housing Development Fund, or HDF, we offer down payment and closing cost assistance. And we are in the state of Connecticut and New York. And we offer down payment and closing cost in Connecticut. In New York, we only offer the down payment. The way it works, I'm going to explain to you, you know, a little bit about our programs. For our programs, you must be a first-time home buyer. The definition of a first-time home buyer is somebody who never owned a home. But if you own a home and you sold the home 3 years ago, you qualify as a first-time home buyer. Now, if you lost the home due to a foreclosure, God forbid, it has to be 7 years if you had a foreclosure. Or if it was a short sale, it has to be 4 years. Mm-hmm. You have to be income eligible. There are income limits for our programs. And that is true for usually for all of the down payments and closing cost assistance that maybe usually has an income limit. For us, if you're buying in the state, in Fairfield County, it's by county. If you're buying in Fairfield County, your household income cannot exceed $121,100. But keep in mind that we have to count the household income, not just the applicant's income, but the household income. Anyone who's 18 years old or older, we have to count the household income. And the household income, and the household is whoever is going to live with you in the property that you're planning to buy, not who's right now with you. If you live with your parents, let's say, but you're going to buy a house and you're not going to live with your parents, then it's just going to be who is going to live with you in the property that you're going to buy. And your income, your total household income, and we include everything, part-time jobs, your full-time job. If you have, let's say, if you got a bonus, commission, we have to count that. Now, if you, let's say somebody in your household gets Social Security, we don't count that for eligibility. Unearned income, we don't count. We only count earned income. So if you get child support, we ask to verify to see for affordability, you know, how much you can afford, but not for eligibility, because child support is considered unearned income. So, but just to let you know, we count only earned income. Now, unearned, the only time that we count unearned income is if it's taxable, and we only count the taxable portion of it, okay? Now, and that program that I'm just describing now is called the Smart Move. The Smart Move program, which but it's a loan. I have to let you know that this is a loan that you will have two loans, one with the bank for 80% financing and 20% from us. Now the payments are separate. Ours is, the interest rate is at 3% fixed for 20 years. The bank, right now, the interest, unfortunately, the interest rate is going up now, and is at around, right now is around anywhere between 4.5 to 4.875. And is in some cases even up to 5% is going. So just to let you know that ours is not gonna change. It's always been at 3%. Fixed for 20 years, because our interest rate doesn't change based on the market. It's always been at 3% and will continue to be at 3% fixed for 20 years. Now, we could lend you, if you qualify, we could lend you 20% for the down payment and up to 5% for the closing cost. But keep in mind, the closing cost piece is just for Connecticut, not for New York. Also, you have to be a US citizen, US resident, or have an approved visa without work permit. Anyone who's under the DACA program that qualifies, DACA program qualifies. Fortunately, TPS doesn't qualify, or if you have a student visa, that doesn't qualify, unfortunately. Now, this is what I was telling you about, that's the Smart Move. That is for down payment up to 25% of the purchase price. Is a second mortgage for 20 years, a 3 interest rate fix. It has monthly payment and it has a fee, and the fee is part of the closing cost, but we could lend you for that fee as well. And the fee is based on the loan amount. Now we have another program called Live Where You Work. And the Live Where You Work, you could get, in addition to the Smart Move, if you are eligible for the Smart Move and you're also eligible for the Live Where You Work, you could get both. And the Live Where You Work, the good thing about that is at 0%. So that's great. It's at 0%, no monthly payments, and it's up to 20,000, but we try to give the exact 20,000. We try to give all of it, the 20,000. And it could be used for down payment and closing costs. But you do have to pay back. It's not a grant, it's a loan, because you are going to pay back when you sell, refinance, transfer title, or when you finish off paying the first mortgage. You have to pay it back in full. Now, to be eligible for the Live Where You Work, you must buy in the city where you work, and any of the applicants. So let's say that there are two applicants. One works in Stanford, the other one works in Norwalk, but you are buying, let's say, in Norwalk, because one of the applicants works in Norwalk, you could apply for that. But there are also income limits, and the income limits is based on how many people are in the household. And there has a $750 fee that is added to the closing cost, but it could be included in the loan amount. Okay, now for anyone who's interested in our programs, you could submit your paperwork, and then we determine whether or not you are eligible to go to the bank to be pre-approved, and if you are eligible for our down payment and closing costs. Now, there are different ways to submit the paperwork. You can either go to our website and you create an account. You go to services, first time home buyer, and then from there, You are going to come to this page, and then you are going to click where it says start your journey here. In there, you will be able to enter your name, your email, phone number, and then you can upload the paperwork. Okay. Now, if you do not prefer this option, you can go to our offices. We have 2 offices, one in Stanford and one in Bridgeport. In Stanford, we're located not too far from here, actually. If you go to Atlantic Avenue, you just go straight, it's on Prospect Street. We're right on the corner of Prospect and North Street. We're on the first floor. Our business hours are Monday through Fridays from 9 to 5. In Bridgeport, the office hours are Mondays through Thursdays from 9 to 4. You can drop off your documents also. You can request the intake form. We can email it to you. We can mail it to you. You can come to the office and pick up an intake form. And then you can submit your paperwork by creating an account in our website. You create a portal account, and then you can upload your documents, or you can come to the office and give us the paperwork. Once you give us the paperwork, it can take up to 10 business days to assess your file and let you know whether or not you are eligible. Now, if you're not eligible, or if you're not mortgage ready, we'll give you an action plan. We'll give you do pay for the credit report, and we'll charge you exactly what the third-party vendor charges for the credit reports. And we pull the 3 credit reports: Experian, Equifax, and TransUnion. And we'll give you a copy of your credit report. But if you're not ready or not, we'll give you an action plan, and we'll tell you, you need to do these things. And then we follow up on you, and we tell you, did you do the things that you were supposed to do? And if you do, then you are going to get closer to being ready. Any questions? Let me open now for questions. Any questions that anyone may have? No? Or via Zoom, if everybody, no questions. All right, so, I just want you to know that also I'm bilingual. I speak Spanish. We have on staff somebody who speaks Portuguese. So, if we have also the intake form in Spanish. So for anyone that you may know, I encourage everybody. What people ask me oftentimes is this a good time to buy? That's one of the questions that I get asked a lot. And what I tell clients basically is when you are ready, because the market can go up and down, but if you are not ready, then it doesn't mean anything. I mean, I could tell you, yes, this is a good time to buy, let's say, but if you're not ready, then it doesn't mean anything. I always tell the clients, if you do not know where to start, take a class. We also offer classes for first-time home buyers. We offer them, right now we're offering via Zoom, but also you can take it online. There is a website, ehomeamerica.org. If you do /HDF and use promo code HDF24, you could take the class, but that class, you do it at your own pace. It's not live, but you do have to pay. I have to let you know that. But if if you are not in a rush to take it, go to the CHFA website, chffa.org, and go where it says home buyer education, and you will see there a calendar. And with the different classes, you will see them, the landlord training, the pre-purchase, even they have post-closing. And then those classes are free, and those are live. It will tell you whether or not it's in person or via Zoom. And usually those classes are 6-hour to 8-hour class. Will be listed there. When we offer the classes, we're listed there. Or if you go to our website, we post there when we're going to have the classes. Yes. Oh, yes, we have a question here too.
Okay, so
let's see in the back.
So we do have a question on the chat. It says,
yes.
Let's see, while it may be tempting to go to an owner directly, a for sale by the owner, the national statistics has proven that 83% of all owner direct to buyer transactions never make it to closing,
Mm.
you need a professional realtor to guide you through the challenging aspects of the process of purchasing a home.
No.
I don't know if that's a
Yeah.
question or observation.
It's an observation. Well, it could happen, but if it's a good opportunity, for instance, my sister, she was looking for a house, and then all of a sudden her neighbor put her house for sale, and she wanted to stay in that neighborhood. She got a good price. So, you never know. I mean, she bought it without a realtor. And it was the neighbor,
Yeah.
and when there are no realtors involved, then it's between the attorneys. I mean, go to contracts, and then the attorneys are doing the negotiation. Mhm.
So there's another question. Are there restraints to the area? For example, am I less likely to receive assistance if I'm looking to move to the Danbury or Bethel area?
All of our assistance is for all of Connecticut. It's not for a specific area. Now, I also recommend clients to go to the HUD website, hud.gov. If let's say you're looking to buy in Danbury, let's say, it might tell you if there is assistance there in that town, or you may want to also go to the town website and see if they also offer down payment and closing costs. But our assistance is everywhere in Connecticut, not for a specific area. But in addition to our assistance, there could be additional that we can combine it. Let's say, for instance, the city of Stanford, oftentimes they offer $20,000 for down payment. And it doesn't have monthly payments nor interest at 0%. And we can combine it with our programs. Now, I have clients that they took the Smart Move, Live Where You Work, and the City of Stanford funds, and they use all of three. So, you may want to see maybe if the municipality, the town where you're buying, if they are offering any down payment, and we can combine it.
So there's another question, and it
Yes.
says, is there a specific type of property I have to buy if I want to receive this assistance?
For our programs, you can buy a condo, single family, or multifamily. Multifamily is defined multifamily residential, 2 to 4 units. More than 4 units is a commercial, and you need to get a commercial loan. Now with us, we have a commercial side, but for us, it has to be any of those types of properties. Now, we do not give our programs is not for co-ops, unfortunately. Yes. We have a question. Oh, yes. Now we're getting now we're getting to ask, and that's great.
We have a question that at 21 years old can qualify for your programs.
If it meets the criteria, I mean, as far as it has to be, it cannot be a minor. So 21 years old is not a minor, but it has to meet the criteria as far as 2 years of a stable employment within the same occupation, the credit also, there cannot be any past dues, collections, charge-offs, and also the income should be enough when looking at the income at the debt, enough to be able to afford. Mhm.
And if he doesn't have savings for the reserves, can the parents be the cosigner?
For our programs, it's not allowed a cosigner.
Oh.
A co-applicant is allowed, but both must live in the property. The property must be your primary residency. It cannot be for investment purposes. So we don't allow cosigners in the sense that somebody consigns to help you buy it and they are not going to live there. We don't allow that. We know that there are certain loan products with the lenders that they allow that, but for our programs, we don't. But in that case, let's say that the 21-year-old doesn't have the savings, is allowed for a gift, that the family member gives them a gift for the reserves.
Okay.
Yeah. It's allowed for our programs, and most lenders allow to if it's a gift, not a loan, but a gift.
A gift.
Yes.
Okay.
Yes,
Great.
that's fine. A gift is fine. Yes.
Thank you.
Yes, yes. Thank you. You had a question? Oh, I see.
Some of them are seasonal,
Oh, I see. So it's, oh, okay. Yes. Okay. Yes, yes. So your name? What is your name? Lisa. Lisa was asking if a cottage seasonal qualifies for our program, right? In that case, no, because that is considered a vacation home if it's seasonal. It has to be your primary residency. For our programs, you must live in the property, it must be your primary residency. With our programs, you cannot buy it and then put it for rent. You can sell it at any time, but while you are the owner and you have the loans with us, then you must live in the property. Now, once you finish paying the loans back, you can rent it if you want. Now, if it's a condo, you have to be aware of the condo rules. Maybe the condo association doesn't let you rent. Now, also you have to be mindful of the first mortgage. If they give you a loan for first-time home buyers, they will have that criteria that it must be your primary residence. Another question? Yes. Oh, okay. Yes.
Does your program include buying land, or is it just houses that are already built?
Yes, unfortunately, land doesn't qualify. In that case, you need to get a construction loan. Yes, to do the construction. Yes, it has to be an existing home for our programs. And it has to be either a condo, single family, or a multifamily.
So we
Yes.
have one more question on the chat. I'm a young adult who would like to buy a home. How much are the classes?
There are two types. There are free classes, and you can go to the CHAFA website, chfa.org. And right there, you will go where it says home buyer education. And you can see all of the classes listed there with all of the agencies in Connecticut, and those are for free. Now, but those are live classes. And oftentimes I have clients that their schedule doesn't allow them to take those classes. There is another one via ehome.org. If you use /HDF, you can get a $24 discount, but those classes are $99. With our discount, you pay $75. And once you start that class, it can take you a month to finish because it's at your own pace. And some people prefer that because they don't have the time to go on a Saturday or evening. But you do pay for that one, for the eHome.
Another, this is more of an observation. Basically, can you just give an explanation in terms of how the gift would work?
Oh, yes. So for us, for HDF, a family member can give you a gift, but not to exceed 6% of the purchase price. And it can give you the gift. It has to be a family member who's willing to give you the money, but you will get a gift letter meaning that the gift letter has to be filled out by the donor, whoever is giving you the money, because it has to be verified where the money is coming from. It has to come from a lending institution where they have their money. If they give you cash, then you have to explain where the money came from. But yes, they can give you a gift, but not to exceed 6% of the purchase price. But you also have to verify with the first lender, because with the bank also they may have their own rules. But for us, it is allowed that they give you money. Now, the only money that has to be your own is the 1% that you have to put down. But the money for the reserves, for the inspection, for the appraisal, that could be a gift. That's it. Anyone else? Yes. The credit. Yes. Oh, yes. Yes. So the question was about the credit. For our programs, if you're planning to apply for the Smart Move or the Live Where You Work, when we're looking at your credit report, there shouldn't be any past dues, collections, charge-offs, judgments, liens, except for medicals. Medicals is okay, as long as you pay them. Now, the other accounts, if we see that let's say there is a charge off, we're going to give you a copy of your credit report and we're going to review the credit report with you and we are going to tell you, do you identify this account? If you identify those accounts and you remember, oh yes, that I forgot to make the payment, then yes, you will have to resolve those accounts if you're using our programs. Now, if you're not using our programs, and let's say you're getting an FHA loan, FHA usually allows for some collections to be there up to a maximum. Certain programs, they don't, depending on the loan program, the loan product that the bank is giving you. But if your goal is to apply for our programs, when we review it, we'll let you know. We'll tell you, you need to take care of these accounts. Now, if you do not identify those accounts, God forbid, could be identity theft, you have to notify the credit bureaus and put a dispute. They are going to do an investigation. And if they will remove it temporarily. If they find that that actually belongs to you, because they are going to reach out to the creditors and they have proof that yes, it belongs to you, they are going to put it back on your credit report. And then they will tell you, they'll send you, and they have 30 days to do that investigation from the time that you notify them. And I will recommend that you do it in writing when you send the dispute, if you are disputing that because you do not recognize that account, or maybe you already paid that account and it's not being reflected. I recommend you can do it online, but it's always good to have the paper trail so you can show that you sent a letter, that you disputed that. And when they receive it, and you send it to the 3 credit bureaus, Equifax, Experian, and TransUnion, they have 30 days to investigate and come back to you. And they'll send you a copy of the credit report and they'll tell you, we verify and it belongs to you. Or they might say, you know what, it has been removed permanently, because they find out that, yeah, it was an error or it was already paid. But yes, that has to be taken care of, any past dues, charge off. You can always negotiate if it's in collection, you can negotiate. But I will recommend that any negotiation that you do with a collection agency, do not contact them unless you're planning to pay it off. You can negotiate and say, you know what, I can pay you less. But if you are not planning to pay it and now you contacted them, they might be starting to call you. I just want to warn you about that. So if that were to be the case. Any other questions that answered your question, or yeah, okay. Anything else, or no? This is a nice facility. I haven't been here in a long time, and it's beautiful. I have to say, with COVID and everything, this is my second in-person actually presentation. It's been 2 years, that we've done presentations via Zoom, but it's good to, to have to see people and just to be able to be in person.
So there's
Yes.
just one last one in the chat. Are the CHFA homebuyer education classes free? I know you covered this, but
yes,
maybe.
those are free. But I always encourage clients to also double check, because there will be a whole list of agencies, but I've never seen any agency who is on that list that charge a fee. Those classes are free, the ones they're on the calendar. But still, if something has changed, it's always good to ask the agency that is listed there just to double check. But as far as I know, those are free, because CHAFA pays for those usually. Okay.
Thank you so much, everyone, for
Oh,
coming.
yes, thank you, everybody. Thank you for coming. And I hope to see you at Housing Development Fund. In the back, I put some pamphlets. It has my business card and a little brochure about HDF. And good luck in your journey of buying a home. You're welcome.